It's a funny thing, right? We can all understand the math of investing. We get the numbers. So why do we still make decisions that end up costing us a ton of money? Well, it turns out the biggest risks aren't always out there in the market. Nope, they're right here, inside our own heads. So let's dive into this and really unpack the psychology that drives our financial choices.
To really get what's going on, let's rewind to a time that's probably pretty fresh in your memory, that massive IPO boom in India back in 2021. I mean, it felt like every single week there was a new, hot company going public, and everyone was talking about how to get in on it. And this slide right here tells the whole story, a tale of two completely different IPOs. On one side, you had Zomato, which just exploded, making investors a ton of money on the very first day. And on the other, you had Paytm, one of the most anticipated, most talked about IPOs, and it just turned into an absolute nightmare for so many. It's the perfect picture of just how high the stakes are when market hype takes over.
Yeah, this whole period was just a perfect case study in what we call market mania. This wasn't just about finance, It was a full-blown psychological event. It was a roller coaster of hope, greed, and for way too many people, a very painful reality check.
Just look at that number for a second. Let it sink in. A nearly 60% loss from the initial price. This isn't just some statistic on a screen. This represents real people's hard-earned savings, their hopes for the future, just gone, all because they got swept up in the frenzy.
So how in the world did we get there? Well, this timeline shows a classic psychological pattern. It all starts with a ton of excitement, fueled by easy money and some early wins. That excitement builds and builds until you hit peak FOMO, the fear of missing out, where literally everyone just rushes in. And then, what happens? Inevitably, the crash comes, and then a slow, painful return to actually thinking rationally again.
And that brings us to the real heart of the matter. Was this just a normal market cycle, or was there something deeper going on? What were those invisible forces pulling the strings inside our brains, making us all act that way? And this is where it gets really, really interesting. We are going to unmask those hidden psychological biases that completely take over our decision-making during these moments of insane market hype. Welcome to the world of behavioral finance. Behavioral finance, simply put, is just the study of why we as human beings don't always act rationally with our money. It's based on a simple fact. We're emotional creatures, we're easily influenced by others, and we take mental shortcuts. And all of these things have a massive impact on the markets.
And look, while these biases are totally universal, they can get really amplified in the Indian context. Here, our investment decisions are often social things, right? They're heavily influenced by our family, our friends. This creates this incredibly powerful tendency to just follow the crowd, especially when we're already giving so much importance to what just happened in the market, like last week.
Okay, so let's break down the 6 most common mental traps that we all fall into. Think of these as the bugs in our brain's operating system when it comes to dealing with money. All right, first up, herd mentality. This is that deep-seated ancient instinct to just follow the group. When everyone around you is rushing to buy an IPO, your brain starts screaming, "They must know something I don't. I better do it too." It feels like the safe thing to do, but man, it's often the exact opposite.
I bet you heard someone say this exact thing during the IPO boom. I mean, think about the reasoning there. It has absolutely nothing to do with financial analysis or the company's fundamentals. It is purely about social pressure and the fear of being the only one left standing on the sidelines.
Now, this herd instinct gets put on steroids by something called recency bias. When Zomato had that amazing listing, our brains created a really simple rule. New tech IPOs make huge profits. Easy. We give way too much weight to that recent success and start believing it's some kind of permanent trend, totally ignoring all the risks.
So what happens when that bet goes south? Well, that's when this incredibly powerful force called loss aversion kicks in. Research actually shows that the pain of losing 100 rupees feels about twice as bad as the joy of gaining 100. It's why so many people just held on to losing stocks like Paytm, just hoping and praying they'd come back.
And selling becomes even harder because of something called anchoring bias. Investors get anchored to their purchase price. So if you bought Paytm at $2,150, that number gets burned into your brain. You start thinking, I'll only sell when it gets back to what I paid for it, even if all the evidence is telling you the company's value has fundamentally changed for the worse.
Ah, yes, overconfidence. During a bull market, everybody feels like a genius, right? A couple of early wins, and suddenly we believe we have some kind of special talent, a Midas touch for picking stocks. And this leads us to take way bigger risks and completely ignore sound, long-term strategies like systematic investing.
And finally, we have the master emotion that kind of ties all of this together. FOMO, the fear of missing out. It's that gut-wrenching feeling you get when you see stories of other people making quick fortunes. It is not a rational calculation. It's a powerful, raw emotional trigger that just pushes you to jump in without thinking.
Okay, so we've identified the enemies, and they are us, or at least our own mental biases. But the good news is, we are not helpless. We can absolutely fight back. So how do we tame our investor brain and actually start making smarter decisions?
The most crucial point is this: you cannot outsmart your emotions. You just can't. But what you can do is bypass them with a system. A disciplined process is the single best defense you have against making impulsive, emotional mistakes with your money.
So here it is, a practical 4-step playbook. First up, acknowledge your biases. Seriously, just by watching this, you're already taking the most important step. You're aware that these biases exist in you. Second, build a system. Put your decisions on autopilot. A systematic investment plan, an SIP, is a perfect example. It forces you to invest regularly, no matter what the market hype is, which short-circuits that FOMO and herd mentality. Third, focus on your process, not on trying to predict the future. A good process means doing research and setting rules before you invest, like deciding on your sell price in advance. That way you're not making emotional decisions in a panic. And finally, diversify. This is your ultimate safety net. Never, ever bet the farm on a single hyped-up story, because even the best process can't protect you from just plain bad luck.
So, if we look back at that whole IPO roller coaster, the lessons are just crystal clear. Trying to time the market, it's pretty much a fool's game. Hype always fades, but the actual quality of a company's business, that's what matters in the end. And a disciplined strategy will always win out over chasing the latest hot trend.
Ultimately, what this all comes down to is a really simple but profound truth. Mastering investing isn't about being the smartest person in the room or finding some secret formula. It's about mastering yourself.
So I'm going to leave you with this thought. The market is always going to have its manias and its panics. The hype machine will always be running. So the next time you feel that emotional pull, that urge to jump in, are you going to be a passenger and just let it take you for a ride? Or are you going to be the pilot and take control? The choice is all yours.